Hello everyone, welcome back to the channel. This is Fair Value Finder. Today we're taking a look at another requested stock. Incorporated, ticker TGNA, which appears to be a media company owning 64 TV stations, 2 radio stations, and they own the True Crime Network. We're going to look straight into the numbers here. We got a 12% growth on top line. Expenses as a portion of revenue have been on the decline. Earnings per share had been climbing up 141% year over year, going from $1.32 to $2.82. There's a drop expected this year, but next year will come in even higher. The share count has been growing. Big red flag, already a no for me. Free cash flow yield. It has a very good free cash flow yield as well as earnings yield. Tangible book value is negative. That is a red flag there. Debt to equity is over 1. That is a red flag there. ROE is right at the bottom that we like to see. Prior year, it had missed the range that we look for. But we come up with a fair value at the end of last year of $39.21, $32.20 this year. So we see that there was a drop in the earnings. There was a drop in the cash flow. The balance sheet got a little bit better, and the dividend stayed the same. They are not big on raising their dividend. They held it pretty flat at 28, rose it a little bit, rose it again, and they haven't risen it in over a year. So we're just assuming that they're going to hold it at 0.38 because they held at 0.28 for a while. We'd come up with a margin of safety buy range down in the high 20s, low 30s. And that is pretty consistent across all of these. So the issue here is that there's no expected growth. The earnings are going to be up next year. Revenue is going to be higher than it was in 2022. But in the past 2 years, the revenue has only grown 5.6% year over year. Cash flow isn't very consistent. 9.1, 25.9, 14.7, 23.2. So the average amongst those is in the 18s. So that's what we're assuming going forward. But we have a stock that at the end of last year had a fair value of 39. And next year, off of projections, off the growth expected, 14. So even if it were to be a potential value play, it doesn't have the growth to sustain it and take the stock further. Fluctuating in the 30s for years now. And it consistently trades at a discount in the teens and 20s. So it could potentially be a hold. There is not a whole lot of evidence saying that this needs to be sold. It is experiencing growth, not declines, but the rising share count and the negative tangible book value are enough to say it does not hit the criteria needed to be a buy for value stock. We can take a look at all of these. We see there's some decent growth for the revenue. Cost of goods is growing as well. The gross profit, net profit, and EBIT all look to be pretty consistent in their distance from one another. We'd want to see this net profit growing, but it's really not at any sort of spectacular rate. 2020 was above trend, and that's the same case for the EBIT here. We see there is some growth. 2020 was above trend, and the same goes for the gross profits. For the balance sheet, assets, pretty stagnant, kind of growing. Tangible assets, negative. The liabilities are on a decent decline, and the tangible book value is on an uptrend back towards being positive. So given some time, the stock might be considerable. But I feel looking at this, the liabilities have to be pretty high. between this and a debt to equity ratio of over 1 definitely make me feel like their liabilities they have been on the decline. Back in 2019, they were very close to the assets. And they really don't have a whole lot that they would be capable of liquidating if need be out of those assets. The cash flows, 2020 was way above trend. We do see some decent growth here outside of that and headed into the future. Dividends, they hold a lot. And for everything graphed, let's see, the cash flows tend to be very high, don't have much correlation to the stock. The balance sheet is very consistent in the growth, so they're growing their assets and paying down their liabilities. Fair value is fluctuating up and down, but trending higher. Earnings, kind of a similar story, but the share price is almost always consistently below these. In fact, the closest of the lines to it is the dividend, which would currently put the stock at $20. But that's all for this one. Hopefully you guys enjoyed the video and are able to see why it's not really a growth stock. It's not really a value stock. It's not really a dividend stock. It's just kind of an old company that's continuing running. From what I read, that the company started in 1906. So they've had quite some time to get their revenues up, and they seem to be stuck around that $3 billion mark. But thank you guys for watching, and I'll catch you next time.